Let's just walk through it step by step. No jargon, no hype, just what the data is actually saying. So as I'm recording this, silver in the US and Europe is sitting at about $82 an ounce. But if you look at Shanghai, that's China's main metals exchange, silver is trading at $88 spot and $90 on futures. That's a $6 gap, and it's been holding there consistently. That's a $6 gap, and it's been holding there consistently. Why does that matter? Because normally when prices are different in two markets, traders rush in to close that gap. The fact that it's staying open tells you that Eastern buyers, physical buyers, are willing to pay more. They need the metal. That's not nothing. Okay, so here's the thing I really want you to understand, because this is where it gets interesting. There's an exchange in the US called COMEX. Think of it like a marketplace where people buy and sell silver contracts. Behind that marketplace, there are actual warehouses with real silver sitting in them. That silver is called registered silver. It's the metal that's available to back up the paper contracts being traded. And here's what just happened. The amount of registered silver in those vaults just fell below 100 million ounces for the first time ever in modern tracking. Right now it's sitting at about 98 million ounces. Nearly 5 million ounces were pulled out in a single day. Now here's where it gets a little mind-bending. For March delivery, there are currently about 65,000 open contracts. Each contract covers 5,000 ounces. So if you do the math, that's about 325 million ounces of paper claims against just 98 million ounces of real silver in the vaults. That's more than 3 paper claims for every single real ounce. And the deadline, called First Notice Day, which is basically when contract holders have to say whether they actually want physical delivery, that's February 27th. About 2 weeks away. Now, most people will just roll their contracts forward or settle in cash. That's totally normal, but the ratio alone is worth paying attention to. If you're trading ETFs or futures, not physical metal, here's the short-term technical picture. Silver recently bounced back above a key level called the 150 exponential moving average on the hourly chart. That's just a line that traders watch to gauge momentum. When price is above it, it tends to act as a floor. When price is below it, it acts as a ceiling. Well, as of right now, price has dropped back below that level, so it didn't hold as support. It failed the test. What that means practically is that silver could move lower in the short term before anything bigger happens. That's just what the chart is telling us right now. So if you're actively trading, be careful. There's no shame in sitting on your hands and waiting for a clearer signal. Protecting what you have is always more important than chasing a move. Okay, stepping back from the short-term stuff, let's look at the bigger picture, the Silver Institute. They're basically the main research body that tracks global silver supply and demand, just released their annual outlook. And the headline is that this is the 6th year in a row where demand for silver is higher than the supply being produced. Let me put some numbers to that. Global demand is outpacing supply by about 67 million ounces this year. Investment demand jumped 20% to 227 million ounces. That's a 3-year high. Industrial demand is around 650 million ounces, which is slightly down because solar panel manufacturers got more efficient and need a little less silver per panel. Mine production is up just 1% to about 820 million ounces. Recycling picked up too, topping 200 million ounces for the first time since 2012. But even with all of that, more recycling, slightly more mining, there's still a 67 million ounce shortfall. And here's the one that really stands out to me. India alone is expected to import around 220 million ounces of silver this year. That's roughly 25% of everything the entire world mines in a year from one country. 6 straight years of demand outpacing supply. That gap has to come from somewhere, and it's slowly draining the world's above-ground stockpiles. Now, here's something that most people covering silver don't connect, but I think it matters. China's holdings of US Treasuries, stocks, and bonds have dropped to about $156 trillion. That's near a 14-year low. And China has reportedly been urging its own banks to sell US Treasuries. So the world's biggest foreign holder of US debt has been quietly stepping back from dollar assets for over a decade. Where does that money go? Historically, it flows into commodities, physical assets, infrastructure, things with real-world value that don't depend on any one country's balance sheet. On top of that, there's an index called the World Uncertainty Index. It basically measures how worried the global economy is. It just surged past where it was during the 2020 pandemic, and it's now higher than it was during the 2008 financial crisis. Silver is up about 150% over the past year. Gold is up 76%. That's not a random rally. When the real economy is getting shakier but hard assets are going up, that's usually a sign that people are losing confidence in paper currency, not gaining confidence in the economy. All right, here's something really specific to watch over the next few weeks. The Shanghai Metals Exchange is closing from February 15th through February 23rd for Chinese New Year. 8 days completely dark. Now, here's why that matters. Shanghai has been the aggressive physical buyer, keeping that $6 premium alive. When they go offline, that buying pressure disappears temporarily. And here's what makes this year unusual. Before the holiday even starts, Shanghai is already in what's called backwardation. That's a fancy word for a simple idea. The price for immediate delivery is higher than the price for delivery months from now. That's backwards from normal. It usually means buyers need the metal right now and supply is tight. Some sellers are even paying fees to delay delivery rather than hand over physical metal. That's a genuine shortage signal. So the setup is China is already scrambling for physical silver, and then they go dark for 8 days. Western banks know that Eastern buying pressure is gone temporarily, so historically this kind of window gets used to push prices lower. Watch what happens between February 15th and 23rd. It might look scary. But then watch what happens when Shanghai reopens on the 24th and those buyers come back. Just to give you the full picture, here's where the broader economy sits right now. The gap between job openings and workers looking for jobs is getting worse, which is usually a leading indicator that unemployment is about to start rising. 9 large U.S. companies filed for bankruptcy just last week. Corporate bankruptcies overall are at their highest level since COVID. Consumer debt defaults just hit 4.8%, the highest in 8 years. So the real economy is showing cracks, and yet commodities are breaking out. That combination, a weakening economy plus rising hard assets, is the classic pattern of currency debasement. The dollar buys less, so everything priced in dollars costs more, including silver. This one's worth keeping an eye on. Texas just announced they're going to produce their own gold and silver coins that can be held inside IRA and 401k retirement accounts. The Scottsdale Mint is involved. It starts with commemorative coins, but the goal is to eventually support larger statewide retirement holdings. This matters because right now, most retirement accounts can't easily hold physical precious metals. If Texas pulls this off and other states follow, and Florida, Wyoming, Montana have all shown interest, you could see tens of millions of retirement accounts suddenly having a clear, approved way to hold physical silver and gold. That's a brand new category of demand that doesn't really exist yet. Look, I'm not here to just hype silver. Let me tell you the real risks. Most of those March futures contracts will probably just roll forward to May. That's completely normal and doesn't cause a crisis. The system also has the option to force cash settlement, meaning you get dollars instead of metal, which is another safety valve. The Shanghai closure gives Western markets a clear window to push prices lower, with no Eastern buyers to push back. The fact that silver is already below the 150 EMA means technicals could get worse before they get better. And paper markets have handled delivery pressure many times before without anything dramatic happening. The bears have legitimate points. Don't ignore them. Here's how I think about it honestly. In the short term, be cautious. The chart is weak. The Chinese New Year window could bring a temporary dip. Contracts can roll or settle in cash. Nothing has to break. But the fundamentals keep building. 6 straight deficit years. More than 3 paper claims for every real ounce of registered silver. Record backwardation in Shanghai. India importing a quarter of global supply. Investment demand at a 3-year high. And geopolitically, the trend away from dollar assets is 14 years old and still going. None of this means silver goes up tomorrow. But it does mean the structural pressure is real and it's building from multiple directions at once. February 15th, Shanghai closes for Chinese New Year. February 23rd, last day of closure. February 24th, Shanghai reopens. Watch the premium. February 27th, COMEX, first notice day for March contracts, March onwards. Does open interest roll to May, or do people actually stand for delivery? Every number I mentioned in this video is publicly available. COMEX vault levels update every day. Shanghai posts its own data. The Silver Institute publishes their full report online. Go look it up yourself. I'd actually encourage that. Understanding how delivery ratios work, what a premium means, why backwardation is a warning sign, That's the kind of knowledge that puts you ahead of people who are just waiting to read about it in the news after the move has already happened. This isn't financial advice. It's just a framework for reading what the data is telling us. Protect your capital, do your homework, and make decisions based on logic, not on what anyone on the internet, including me, tells you to do. See you in the next one.